Let's stay with auto. Samvardhana Motherson is the next company on the radar. Third quarter numbers largely came in line with expectations. Margins were higher than estimates. They've also witnessed a sharp reduction in gross debt. We are joined by Pankaj Mittal, Chief Operating Officer, and Kunal Malani, Chief Financial Officer at the company, who are with us to take some questions. Gentlemen, good morning. Good to have both of you here. Prashant this side. Pankaj, so third quarter largely in line, but concerns remain around demand, especially in the European market. And over the last few months, we've seen majority of the European OEMs reporting decline in production. Could you give us a sense there? I think we've started last few conversations around this, but this still remains top of mind. Is the situation at the margin improving at all? And I'm taking my cue for that question from at least stock markets in Europe, which are starting to recover after many, many years. You look at, the FTSE, the DAX, other markets, the Euro Stoxx 50 starting to come up a little bit. But tell us, from a real ground-up level, especially in the auto side, what's happening?
A very good morning, and thank you for bringing us on the show. Motherson has a very diversified portfolio. So you see our performance in the light of a transitioning industry, where this diversity has given a very resilient and stable performance. Europe automotive market, or for that matter, any other automotive market, may have some bumps up and down. But automotive demand continues to come back as people really want transportation all across their life, and it'll not come down in a long run. So we remain embedded with our customers. We continue to develop all kinds of vehicles, be it hybrids, ICE, or EVs. And as you see, that most of our business portfolio, nearly 95% of it, is powertrain neutral. So in that sense, Samvardhana Motherson is positioned in a very strong way.
Gentlemen, before we talk about the Q3 numbers and the projections from here on, I just want to get this whole international uncertainty around tariffs, this whole conversation out of the way, because you have lots and lots of assets overseas, and obviously you're pretty big in exports. So first up, what is your total exposure to the US market? What is the quantum that you're exporting to it? Because I think you have various entities, I think some of them perhaps even in Mexico, some of the recent acquisitions. So just tell us, what is your net exposure and what are you preparing for in case those tariffs in the US, if they go up? Kunal, you want to take that?
Sure. Good morning, everyone. Look, we are around about 18% odd in the US in terms of our presence there. Mexico is around about 4% odd. Reality is we have a global local policy or a global local strategy. We manufacture where we are selling, so it is not that we are really importing, exporting too much of our parts. Having said so, there are obviously commodities which move in and out, and commodities in general is passed through in most parts of the world.
Kunal, if I could interrupt just to understand, when you say 18%, are you saying 18% of your revenue comes from the US?
That's
and Mexico
right.
And Mexico is 4%. So 4% of your revenue is Mexico.
That's right.
Sales to Mexico.
That is sales largely to Mexico. There will be some flows that will happen from Mexico to the US. But all of these are structured with a pass-through element in place, right? Or a large chunk of it is structured as a pass-through element, because any customer-nominated parts as well as commodities will have a pass-through element largely for us. So any tariffs movement there really does not have an implication for us. Now, there are some parts which will be being bought by us and imported and exported, while the numbers will be small, and hence any impact there is going to be muted. Plus, the final impact is frankly going to be at the customer end and at the end consumer end, because it's not a challenge for us, it's a challenge for the industry as a whole. And hence, if there is anyone who will have to bear the brunt of it, it'll finally end up being at the consumer end / the customer end, depending on what price point it does.
But it's about competition, Kunal, right? Sorry, I mean, just because of lack of time, I'm interrupting, but it's all about competitiveness. Now, if your products will be priced higher if tariffs go up, then what about potential loss of market share and competitiveness?
That's where I was coming to. So in the short term, the reality is it is not possible to change your supply chain overnight, right? At least for the product chains that we make, right? So for us, the implication will be a pass-through. And in the medium term, actually, it's probably going to be a slightly positive phenomena for us, because we produce, as I said, locally. And having a presence in 45 countries, we can decide to, rejig our production planning in such a way that we can produce in, let's say, more favorable nations going ahead, versus someone else who possibly does not have the kind of spread that we do. So in overall, it's neutral to positive, the way we would see it on the tariff front.
Okay, so now with that out of the way, let's come back to the numbers and the expectations from here on. So given the talk of some recovery in the European markets, Mr. Mittal, if we could come back to you, how does FY26 look at an aggregate when you combine all the businesses put together? What's the sense that you have in terms of top line growth?
See, for us, we see opportunity in all kinds of situations, like you mentioned. So we are an acquisitive company, and due to a lot of uncertainty in the market and markets going down or going up, there are lots of opportunities for us on the acquisition front, which our customers are talking to. So apart from organic growth, we are also looking at good acquisitive growth in times to come. And that's why you would have seen that we have also deleveraged ourselves. We are in a very strong position. Our balance sheet is strongest maybe in the last 10 years. So we position ourselves as a very good candidate, working together with our customers, being a very stable and a reliable partner with the entire industry. And on the other hand, we are also diversifying ourselves. As you would have seen that we have also started operations on the consumer electronics business. Our first facility is already ramping up. There are 2 other plants which are on track for SOP in the coming years. So we do see as a company, we continue on our path of creating a more diversified and a strong partner to the OEMs.
Can you, help us map that in terms of some sense of, revenue CAGR when you usually do these 5-year plans, right? And I think is it already time for the next 5-year target or not? Because the revenue at 36 billion target with 40% ROCE, I think that was the earlier target, is it? So what's the new roadmap, CAGR growth and margins next couple of years?
So still, we have to achieve 36 billion. So it's still some way to go, few more weeks. And then we will be coming with an announcement about our next 5-year target. So it is not, as you rightly mentioned, it's not just our top line, but let's wait for a while before we come with the next target. So teams are very excited. They're all working. These are all bottoms up. Everybody in the world works together to set their next goal.
Okay, fair enough. Very quickly, on the 2 new acquisitions that you'd announced in the 3rd quarter, Kunal, if I could come back to you. At Sumetic and Baldi Auto, one is a Japanese entity, the other I think is a Brazilian entity. When do revenues from these 2 start kicking in?
We are aiming to close both of them by end of this financial year. So while I think revenues won't be visible in Q4 as much, though the balance sheet may get assimilated, they should be visible in Q1. That's at least the current plan, subject to regulatory approvals.
Okay. And finally, Kunal, just leave us with an outlook on debt reduction. I mean, it's come down again in the 3rd quarter as well. What is the, how will you end the year in terms of total capex? Because I think there's a slight revision, downward revision in the capex outlay as well for FY25 and debt. Where do you see the end of the fiscal year on both these counts?
Yeah, we've reduced the capex guidance to 4,500 crores from 5,000 plus minus 5. Primarily in order to realign our capex planning along with the SOPs that are being planned by the customers. So to the extent we can recalibrate, that's what we have done. Most of this reduction or delays, if I were to put it, is going to happen in the developed world. The emerging markets and the greenfields are largely in line with what the earlier expectations were. So there is no rollback on any of our growth capex going ahead. From a guidance on leverage, we are at 0.9x. We are aiming to close the year somewhere between, let's say, 0.7 to 0.8, subject to any new M&As. We do anticipate a fair amount of working capital reduction to happen, as we've always been saying. I think now we are seeing some of the geopolitical tensions getting potentially eased out. Freight rates coming down, supply chain being a little bit more predictable, and hence the ability to then rejig our working capital, which we hope to achieve part of it in this quarter, part may move into the ensuing quarters. So overall, we should still be on a deleveraging path somewhere around 0.7 to 0.8 or better.
Okay. All right, gentlemen, thank you very much for joining in, giving us a sense of the business and your overall plans going ahead.